friends, today's topic of discussion is inflation accounting. These are the following topics we are going to cover in this video. Let's start with understanding the meaning of inflation. Inflation is that state of affair when money in circulation is more than the production of commodities and services, and purchasing power of money comes down and prices of commodities and services increases. So, inflation accounting refers to the process of adjusting the financial statement of company to show the real financial position during the inflationary period. While the cost in traditional accounting refers to historical cost, in inflation accounting it represents the cost that prevailed at the time of reporting. It is a special accounting technique that is used during the period of high inflation. It requires adjustment in financial statement of a company according to current price index prevailing in the economy. The technique of inflation accounting has been developed to correct the problems arising from historical cost accounting in presence of inflation. Inflation accounting involves the recording of business transaction at current value to analyze the impact of changes in price or business transaction on cost and revenues, assets and liabilities of a company. Next is effects of price level changes on accounts. Financial statements are usually based on actual or historical cost concept. They reveal the impact of various transactions involved in the accounting period on operating and financial health of the company. But measurement unit of various transactions, that is money, relates to different points of time, and the value of money does not remain same over a period of time. It has different values at different point of time due to changes in the price levels. So, the profit or loss arrived from these transactions will not reveal a true picture. So, profit as arrived from profit and loss account on the basis of historical cost has a tendency to be overstated in times of rise in prices. And there are two causes of overstatement of profit during inflation. One is writing off depreciation on fixed assets at a lower rate than it would have been, and the other is overvaluation of stock in trade. And the effect of inflation on fixed assets is still worse because low provision for depreciation on the assets valued at historical cost not only show high profits but also result in non-availability of sufficient funds for replacement of fixed assets. Thus, accounting based on historical cost concept inflate book profits, increases tax liability, and erodes equity capital. Next is needs of inflation accounting. First is inaccurate presentation of financial statements. Next is unrealistic, imaginary, and inflated book profits. Increased payment of dividends and taxes because of change in the price level, resulting in the erosion of capital. Difficulties in replacement of fixed assets during inflation. Inadequacy of working capital arising out of increasing price levels. And the last is losses arising as a result of holding monetary current assets and gains arising as a result of holding current liabilities. Fine. This is limitations of historical accounting. Significance of inflation accounting emerges from the inherent limitation of the historical cost accounting system. So the first one is fixed assets are stated at historical cost in the balance sheet. They do not show the true current worth or are often unrealistically low. Next is historical accounts do not consider the unrealized holding gains. In the period of rising prices, there is a significant overstatement of profit since the cost of goods sold is calculated on historical cost basis and no allowance is made for the reduction in the purchasing power of money. Also, overstatement in profit result in a very heavy financial strain for the company in terms of heavy dividend, heavy taxation, etc. Fine. Next is depreciation is charged on the historical cost of the assets. As a result, depreciation provision is also inadequate for financing the replacement cost of fixed assets. The firm may therefore have to face serious problems because of lack of funds. And the last is future earnings are not easily projected for from historical earnings. Fine. Next is techniques of inflation accounting. There are two techniques of inflation accounting. First one is current purchasing power method, and this method is based on changes in general price level changes, and the next is current cost accounting method, which is based on changes in prices of specific assets. Fine. Now let us learn in detail what is current purchasing power method. Under current purchasing power method, any established and approved general price index is used to convert the values of various items in the balance sheet and profit and loss account. In this method, all the items in the financial statements are restated in terms of a constant unit of money, that is, in terms of general purchasing power. And for this purpose, approved price index is used to convert the various items of historical financial statement. Retail price index or wholesale price index is taken as an appropriate index for the conversion of historical cost item to show the changes in the value of money. This method takes into consideration the changes in the value of items as a result of general price level, but it does not account for changes in the value of individual items. Fine. There are several techniques of preparing financial statement under current purchasing power method. First one is conversion technique. In current purchasing power method requires conversion of historical figures at current purchasing power. In this method, various items of balance sheet and profit and loss account are adjusted with the help of recognized general price index. Fine. For this purpose, historical figures must be multiplied with the conversion factor. For understanding this, let us take an example. A building was purchased in 1995 at a price of 90,000 and the general price index at that time was 150. We are required to convert the figure in current rupees on 31st December 2002 when the index stood at 300. So, the formula for calculating conversion factor is current price index divided by previous price index. So, the converted value will be 90,000 multiplied by 300 divided by 150. So, the value will be converted value of building will be 1,80,000. Fine. Next is mid-period conversion. There are several transactions which take place throughout the year, such as purchases, sales, expenses, etc. For conversion of such items, average index of the year can be taken as a one index for all such items, and if such average is not available, then the mid-year index will be taken. Fine. Last is monetary and non-monetary accounts. Monetary accounts are those assets and liabilities which are not subject to reassessment of their recorded values with the change in with the change of purchasing power of money. An example of such items are cash, debtors, creditors, bills payables, etc. And other assets and liabilities, the value of which do change or are subject to reassessment along with the change in purchasing power of money are called non-monetary items. And point to be remember here is that in the process of conversion, it is only the non-monetary items which are adjusted to the current purchasing power of money. Second technique of inflation accounting is current cost accounting method. The current cost accounting method refers to an approach that values assets at their fair market value rather than historical cost. In practice, current cost can be determined in a number of ways, including applying a specific price index to the book value of the asset. Fine. Recording transactions at historical cost is one of the long-standing principles of the accounting profession. However, this approach has its critics, especially when an economy experiences double-digit inflation or process improvement result in a relatively rapid decrease in prices. As a result of this, a number of alternative approaches to the reporting of financial statement have been proposed, including current cost accounting. The objective of current cost accounting is to report the financial assets and liabilities of a company at their fair market value rather than historical cost. There are other techniques of inflation accounting. First is only putting a note in accounts. A note is appended to show changing price level in account presented. Thus, no changes made in the accounts, so profit will be in excess only, and enough amount is not available for replacement of the asset. Fine. Next is replacement reserve method. Accounts are prepared on historical basis only, but additional amount required for replacement purpose should be transferred to replacement reserve account every year, and replacement cost is estimated and will be spread over future period. Fine. And the last is partial change method. In this method, fixed assets are generally written up and stock is valued on the basis of LIFO method. Link of fixed assets is in accordance with legally established index, so profit wouldn't be higher. It will reflect true profit or loss on price level change. Next is limitations of inflation accounting. First is a change in the price level is a continuous process, so it becomes very difficult to make changes in the accounts every time, right? Next is this system makes the calculation very difficult task because of too many calculations and conversions, and this system has not been preferred by the tax authorities. This was all about inflation accounting from my side. Thank you for watching.